Welcome to my channel. I'm the cover call guy. Happy Thanksgiving. The market is closed, but don't forget to buy. Enjoy your feast today if you do celebrate it. Tomorrow the market is open. We have about 4 days left of the market, so let's end the month strong. Legal disclaimer before we start this video. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Please, trading and investing involve risk, including loss of principal. Always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you found online, and I could be completely wrong. With that out the way, today's video is going to be on one that had quite a few likes because I did fumble on TappAlpha when I made the ranking of the best duels. And instead of redoing the entire video, I just thought, why don't I just hold T Alpha against NEOS, right? NEOS is everybody's favorite. NEOS is, in my opinion, the top dog, right? I mean, it's right now undefeated. It does everything, it is pretty much you can buy QQI and SPYI and that's it. That's all you really would need if you have a higher risk tolerance. That's really all you would need. So I'm just gonna go ahead and compare T Alpha to NEOS and just look at the key feature differences between the two and see how would you rank it. Would it fit in your portfolio, or would you just keep NEOS in the list, right? So a few people did comment about T Alpha and it did get a few likes. So yeah, I did fumble and didn't add it to the list. So I'm just gonna go ahead and compare these two and see how would it rank against NEOS and see if it deserves a top 5 spot. All right, my market ranking and scorecard. I give this a high 7. I was gonna give it around a 6 to 6.5, but I think it deserves a 7. Why the high score? Proof of concept in the brutal ETF arena. Most new funds die, and T Alpha is a new fund. Right? The T Alpha didn't just survive; it amassed 140 million plus. So it is a new fund, and it amassed and amass that much this quickly. So once it reaches over the 100 million mark, that's usually my benchmark. Over 100 million in such a short time frame means the fund is popular, is gaining traction, and it is doing something right. That means people are pouring money in because it's doing something right. Right? It deserve a spot in a lot of people in a lot of people's portfolio, right? So the mathematical alpha, they are beating the Nasdaq benchmark net of fees. The 0 date to time expiry premium harvesting is generating raw alpha. So people are buying this because they are doing this strategy and executing it right. However, I do have to mention that I didn't have space here. We are in a strong market, and with that strategy in a strong market, they do perform well. Why not a perfect 10? I did have to take away at least 3 points because I think there is a structural handicap here. The double fee structure, a 0.09 AEEF, and a lack of Section 1256 tax treatment act as a permanent drag. So if you are holding this with a long-term intention, you are basically tying at least one of your hand back, right? And you're handicapping yourself because of this. You are starting the race with a weight vest. So because of the 0.09 AFF fee and no Section 1256 tax treatment, in terms of very, very long term hold, it will weigh you down. What is the AFFE fee? Basically, it means acquired fund fees and expensive. Basically, it just means you're paying for multiple middle managers, middlemen. So it may not seem like a lot. However, over the course of how many years or decades you hold, it does add up, right? So just something to think about. And then the whipsaw tail risk, and I had to take away another 1.5 points. Um, Basically, a whipsaw is when you're kind of chopping wood, not chopping wood, when you're sawing wood, right? If it pulls one way too hard and it stays that way, you feel the effect. As if someone pulls the other way and it stays there for too long, you feel that effect, right? So it's whipsaw. It's cutting off like a circulation. 0 day time expiry strategies have gamma risk, and a violent V-shaped recovery. The fund could theoretically lock in losses daily, because remember this is a daily strategy. This hasn't been stress tested in a 2020 style crash. So I almost, I did almost add minus 2 points here to put it down to a 6.5 because of this. It has not yet been tested. So I did give it a 7, but if I were to really put it in a range where if it's not deserving of a 7, I would say it's a 6.5, just because it has not yet really faced a um, stress test in a actual crash or down market. Remember, it's doing very, very well because it's locking in daily gains where the market is going up. So we do have to be aware of what could happen in a crash or a downturn market where you are now locking in daily losses. All right, the risk reward equation. My bull case for this, I give it an 8 out of 10. The cash flow engine of the 14% yield right now is not just a number on the screen. I think in a choppy or flat market where the S&P does 0%, this fund basically is a money printer, right? It just prints cash. It converts waiting into earning. Liquidity velocity, 41 million under assets under management, and under 3 months for a TDAQ is rare. So this is very good. In 3 months, they amass almost 50 million, right? So so they are very, very liquid. So when it becomes very liquid, that means everybody can get in or out. And typically, when it becomes liquid like this, everybody usually gets in, right? So it's just money piling on top of money. And when the word spreads, it gets even bigger, and it's just a snowball effect. Right, this rapid scaling ensures tighter spreads and better execution for you as an investor. Right, the lower the bid ask, the better it is. The 0 day time expiration edge, uh, theta decay exponential. By selling only the last 24 hours of an option, they are harvesting the most expensive part of the premium curve every single day. My bear case for this is risk realized. Death by 1,000 cuts, right? The tax inefficiency is brutal. If you are in a high tax bracket, that 14% yield might effectively become 8% after Uncle Sam takes his cut of ordinary income. The alpha evaporates in a taxable account, right? And then I go back to the whipsaw, the gamma risk. Imagine if the market drops 2% at open, the fund sells a low strike and rips 2% higher at the close. The fund buybacks high again. This is whipsaw, right? So it pulls one way for and holds there, and you end up taking the unfavorable outcome, and then it pulls the other way, and it stays there for too long, and you sell at the unfavorable outcome, right? So a daily reset strategy can theoretically lock in losses daily during high volatility, eroding NAV faster than you can blink. Fact check structure and fees compared to NEOS. NEOS beat them in a structure. In my opinion, direct replication holds stocks. Um, T Alpha holds ETF, right? It's not. I don't think it's not a funds of funds. I just put funds of funds, and then I should have put a slash hold ETFs, and it holds ETF. So that was just a kind of a typing mistake. I meant to put slash and then pick one. So it holds ETF. It's not a funds of fund. But in terms of structure, I would say NEOS is the winner. Management fee is the same exact, so that's high. AFFE fees, NEOS has 0 compared to 0.09. NEOS is the winner. Total expense ratio, NEOS is the winner. Category winner, NEOS. Lower cost and better structure, in my opinion. All right, strategy and mechanics. NEOS is monthly, T alpha is daily, right? Implication T alpha equal max data harvest, option type. NEOS is section 1256. T alpha is equity index. NEOS equals 60/40 tax advantage. Upside capture. NEOS does call spread, long leg, right? T alpha does daily strike reset. NEOS equal better for rallies. Downside reset. NEOS is monthly. T alpha is daily. T alpha equal better for crashes. Category winner, I'm gonna still say NEOS, right? It still has a stability versus T alpha, which is all about the higher yield, right? The higher premiums. Uncle Sam always wants his cut, right? NEOS is the tax shield. 1256 contracts, tax gains are taxed at 60% long term and 40% short term gains. This applies regardless of holding period. It is a massive structural advantage for high net worth taxable accounts. And on this channel, if you're a subscriber, we aim to be high net worth in a taxable account. T alpha, the tax drag, right? Straddle and constructive sell holding ETF plus shorting the option triggers complex IRS rules. Most income is likely ordinary income, short term, can be taxed at the highest 37%. Losses on the stock leg may be deferred. It's messy for taxable account. Category winner, I'm going to give it to NEOS uncontested in this section. Shared characteristics, right? The structure, both exchange, both are exchange traded funds, ETFs, regulated under 1940 Act, both overseen by U.S. SEC. Primary objective: high current income. Target U.S. cap equities, S&P 500 and Nasdaq. Utilize call options and engage in selling, writing. Actively manage, not passive index trackers. Charge a base management fee of 0.68%. Distribute income monthly. Trade on a U.S. national security exchange. Publish portfolio holdings daily. Uses AP for liquidity. Principal is at risk in both. Category winner, neutral. They pretty much do the same thing. So it is a industry standard in terms of structure. It's pretty much the same. So this in terms of these area, none of them hold a true advantage over each other. All right, share characteristic, market and operations. So, subject to stock market decline, rally on implied volatility for premium levels, trade off some upside potential for income, right? Capped upside, offers better inflation protection than cash, less sensitive to interest rate than long bonds. Typically carry a beta of under 1 versus the benchmark, which is good. Highly correlated to S&P 500 and Nasdaq, available to institutional and retail investors. Marginable securities, hold cash slash collaterals for operations. Settle on a T+1 cycle. Have chief compliance officers category. Verdict: neutral industry standard. They don't have an edge over one another. They essentially in this area does the same exact thing, play by the same exact rules. Share characteristics, risk and marketing, right? Focus on total return, income plus price, classified as non-diversified, sector concentration, face OCC, counterparty risk on options, rely on technology slash trading system, have cybersecurity business, community plans. They comply with all the regulations subject to FINRA, SEC marketing rules, maintain investor facing websites, eligible for drifts on all brokerage, governed by board of trustees. So in terms of this area, category winner, neutral, it does the same exact thing. It doesn't hold an advantage over the other. All right, differences: structural and operational, right? Features: NEOS does direct replication. This is T alpha. I don't know why I put funds of funds. I meant to put these together. It's not a funds of funds, so not a funds of fund. It holds ETF. It holds the ETF. I meant to put these together and just put a comma here, but it holds the ETF is not a funds of fund. The assets, right? Stocks to ETF expense ratio. NEOS is better. The listing, I mean, it just depends on where you want to put it at. It's essentially not favor over the other. I mean, Nasdaq could be favored. Asset under management, NEOS is gonna outshine T Alpha here. NEOS has like 15 billion, I think, or 16, 17 billion. And T Alpha total is like 145, 150 million. Liquidity, NEOS is gonna win here. Subdivisor, none, right? And T Alpha, and this is why you're paying a higher um, as expense ratio. Right, NEOS has none is internal, so it could be much lower. So NEOS here wins scale and efficiency. Strategic strategy and risk, right? NEOS, they both um, NEOS does monthly calls, whereas T Alpha, like I said, does daily resets. The strategy is for NEOS is call spread. T Alpha does the cover call. NEOS gamma risk is low. T Alpha is extreme because it's daily reset. Bear market, NEOS holds strike. T Alpha adjusts daily. NEOS how it performs in bull market outperforms, and T Alpha can lag. NEOS execution is 12 trades a year, while T Alpha, because it does it every single day, is 252 trades per year. Category winner, this one is going to have to be what you want in your portfolio. My content dependent. It's going to be a core versus satellite. I think NEOS would be a core, and there's nothing wrong with holding T Alpha as a satellite, where NEOS is a bit more stable, and you can have T Alpha as kind of that extra juice. It just depends on how you want your portfolio set up, your lifestyle goals, where you're at in life, what fits your needs, right? So if you're single, just living life, you're okay with this having as a satellite and having as a big position. There's nothing wrong with that. This one is just gonna be your preference, so it's gonna be your personal bias. Tax and regulatory, like I said, NEOS is gonna win here, right? NEOS, the category winner here is gonna be NEOS. It's just more tax efficient. I mean, T Alpha here is going to just lose on this section. NEOS, a long term tax efficiency just wins here. Brand and marketing, NEOS, of course, right? NEOS has that trust and legacy right now. They are a solid um contender for matching up to the Titans of JP Morgan and Goldman. NEOS is really kicking ass right now. Um I don't even know what I have to even say about it. I mean, it speaks for itself. When you think of the best cover call ETFs, you're gonna probably think of NEOS. They are just absolutely dominating. So category winner here, NEOS, without a doubt. I think everyone's gonna agree with that. My verdict, right? NEOS still reigns supreme. It is the gold standard. NEOS remain king of income stability. Why? Because high yields mean nothing if your principal erodes, right? So NEO's call spread architecture protects your NAV, ensuring your income stream survives market rallies. The net spendable reality, it's about what you keep. NEO's combine lower fees with a structural tax shield, 60-40 split. T Alpha forces you to sprint just to stand still against higher fees and ordinary income tax. So it's not a bad thing, but it's just depending on how long you want to hold this, and then how long of a drag you're willing to take. Right? So T alpha does have the pure velocity play, right? T alpha is superior in the sense that it's a tool specifically for flat, choppy, or slowing, bleeding markets. When the S&P is stuck in neutral, right? T alpha's daily data harvesting squeezes blood from a stone, generating cash when directional strategies starve. So T alpha does deserve to hold a spot in your portfolio. It is a strong satellite contender. It does it do exactly what NEOS does in a sense? No, because T Alpha does its own thing. It has its own strategy. It doesn't it 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 plays the same market, but it just does things a little bit differently. Doesn't mean it's worse. As you see, I gave it a 7 out of 10. It could be a 6.5 out of 10, which is still high. Um, in terms of the top ETF duos, I think this would be a top five for sure, maybe even pushing a top four. Just because also it is new, we haven't seen it stress test yet, so we have to have it stress test so it could actually be a contender. And if it does well in the stress test and it rebounds, I'm gonna say this is a top three for sure. It has to rebound. Remember that. Just because there's a lot of money coming in and is doing well right now, in a strong bull market. Yes, right now we are still in a strong bull market. We have been going down for the past week and a half, but if you zoom out for year to date, and you just see a straight green line going up. We are in a strong bull market. So until it's stress test, I don't think it's going to be higher than a top five. I would say it's in the top five, considerable. It definitely 100% deserves a spot. You can either have this or the or my other what is it, the I Spy IQQ. So it deserves somewhere around there, right? So it's 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 gonna do well and overtake if it can hold. We just have to see in a market where it doesn't bleed out and it doesn't recover. Oh, did it get cut off? Oh, my PowerPoint got cut off. I didn't realize that. Yikes! I did not realize that. Why did it do that? But I said anyways. All right, it didn't get cut off too much. But yep, that's my verdict. I don't know if you guys agree, but right now I give it a very high score because of how it's operating, how it's doing overall. Um, did it deserve a little bit lower? Maybe, just because again, like, we haven't seen a downturn yet. Thanks for watching. If you found this analysis helpful, please like, comment, subscribe. It really helps my channel. It really, I'm thankful and grateful for all the support. Thanks for watching, guys. Catch you guys on the next. Stay tuned.